Non-farm payroll, what a miss. Hi, everyone, and welcome to another week of Insights brought to you by Ainsley Bullion and the Gold and Silver Standard. It's Monday, which means Alex is here, and today she's joining us to discuss the much better than expected unemployment data that came out of the US late last week, which has significant implications for policy decisions going forward for the US, here, and around the world. So how are you going, Alex?
I'm really well. How are you going, Chris?
Yeah, good. Just overcoming a little bit of a cold here, but I'll battle through it. So lots of interesting stuff happening late last week. We saw that data really surprise quite significantly. It was quite a bit better than expected. Can you give us a bit of an overview, but also maybe a bit of background about how big of a surprise that was, or was it really a surprise?
It was definitely a surprise. I don't think we can avoid those numbers. So 517,000 versus 185,000 expected. But in a percentage term, it was around 179% miss. Whereas actually, interestingly, January 2020 was a 221% miss.
So we've been there
Unusual.
before in terms of getting these numbers wrong.
This is not an unusual hitch in the road, so to speak.
Yeah.
Um, but we've had this downtrend in the US dollar for since probably September, October last year, and it will cause a hiccup in that, and it has slumped gold prices in the last little bit. But realistically, if you look at the numbers, it was a huge miss there. And in fact, you look at the unemployment rate, it's dropped to 3.4%, which is the lowest it's been, since 1969. But the participation rate is still a full percent off what it was pre-COVID. So they're still not back to where they were, whereas a lot of other countries are. And interestingly, the number that the Fed keeps talking about more than anything else is the wage growth. Because if you've got wage growth well under inflation, there's less ability to raise rates, and there's less reason to raise rates because the labour market's not feeding into your inflation figures. So it wasn't a miss on the wage growth. It was probably exactly where the Fed wanted it to be. And if they can look past this number, just like what happened in January 2022, it's not as big an impact as the markets immediately shown.
Right. And I think that's interesting. I'd like to dig into that a little bit more too, because like you said, you can have the big number being a big miss and everyone not quite seeing that coming. But when you dig in, there's more to it, as there always is. I'm particularly interested to dig into this concept of unemployment, as you're highlighting there, because if the Fed's trying to dampen the unemployment, that's clearly not working, but it is, like you said, working for the wages to some degree, because we've got those not shooting off for inflation issues, but the unemployment itself is staying strong. Why is that, do you think? I know when we've talked about it on here in the past, you've mentioned things like demographic changes that could be at play, but is this something different to what the Fed's used to? Because they really have been saying quite clearly that they want to put a dent in unemployment, but it looks like that might not be happening.
Well, I mean, since COVID, the participation rate in the US has dropped. And in fact, I think 2008 was peak participation rate for a while in the US, and it has been continually dropping ever since. So looking at those numbers, if I was 64, 65, and I've moved off from the labor force, and suddenly I'm facing food prices that are 10% higher, and if I've got a mortgage, I might have to put more in there if I want a holiday. I mean, if you've got a holiday in Australia, the last inflation figures were 13.3%. You might want to go back to work and just cover some of your costs. So what you're actually seeing, I think, is a more dynamic participation rate, that as jobs become available and you've got more cost because of what's going on, you actually have the ability to jump back into the market. So there's got to be not only seasonality, because you've got the December quarter where everyone's on holidays, so people are jumping in there, but you've also got I need to pay for this. Why don't I jump in? There's a good job. And I think that might be helping to dampen what's going on with the wage growth. So I think at some point, and we've spoken about this a lot, unemployment rate becomes less relevant than it's ever been,
Mm.
because you've got baby boomers retiring, you've got these mass demographic changes, and you've had a dropping participation rate since 2008, which allows for a more dynamic ability for the market to adjust, which I think you're more likely to see in wage price growth than anything else. So as long as that's staying down, you're probably heading for what the Fed wanted with this soft landing. And I mean, looking at the data from January 2022 to 23, there's a graph in the Ainsley News today showing what happened to DXY between January 22 and October, where we had that huge run up.
Mm.
It's not like the inflation differential at that point in time was on an average around 3.3% on a few other countries we compared it to negatively. And now we're at a positive 0.3%. Other countries, if the US raises, other countries are not going to let what happened last year, which is the devaluation of all their currencies. They are just going to have to raise rates at a faster rate because they're well behind now the US. And in fact, their inflation figures are a hell of a lot higher than where they were. So we're not going to see the same strength in the US dollar this year as we did previously.
And I think that's interesting as well too. Or we have to hope a little bit that the Fed sees that this is actually a different set of circumstances to what it has been in the past. Because I think a lot of people in the market will be looking and going, "Oh, well, here we go again. We're back to that previous part of the cycle." But from what you're explaining there, it's actually different. It's changed. The dynamic has changed when you're talking about that being a really dynamic and flexible workforce. That's changed. So you can't just use the old antidotes or the old rules and expect that you just need to apply them in the same way, because it's a different situation now.
Yeah, and I mean, look at 2022 versus 2023. We've spoken a lot about de-dollarization. That is not going away. That is going to continue at an increased pace. You've got China right now. What happened yesterday with the US shooting down the balloon or the weather balloon or the spy balloon, whichever way you want to
Depending
be.
to who you're listening to. Yep.
So there's an escalation going right on, and then you've got inflation now in other countries more so than the US. I mean, Australia right now is at 8.4%, and the US is at 6.5%. We have to raise more than the US right now, or we have to keep ahead of the US, or we will see more ingrained inflation.
Right. So that's where you see it for the RBA, because I suppose my question around that is, you've identified that multiple times. I mean, the last few times when we were talking, you've been cautioning that we are falling, we're already far behind and had the risk of falling further behind. So what do they have to do on Tuesday to really fix this?
So Canada's at 4.5%, New Zealand's at 4.25%. ECB right now is at 3%, so they're under us because we're 3.1%, and the US is at 4.5%. ECB on the last interest rate, inflation reading, everyone's pricing in 0.5%, so we'll even be behind them. We have Lowe, who is a little bit dovish, which is fine. But if we don't catch up on this cycle, we are going to see the Aussie dollar depreciate pretty quickly right now, especially off US data like that. And what you are going to see then is greater inflation in Australia. So if they do not raise by more than what the market expects this time, the market's expecting 25 points. I think it's like 97% likelihood.
Yep.
If we do not raise by more than that, we are going to fall fast behind and we're going to have greater inflation. So I think my opinion is we should be raising 0.4% in this cycle. We've missed an entire cycle anyway. The 0.4% is because the pre-COVID, we dropped to 0.1. We've got this funny number going on where we're at 3.15. And so we've got this funny number going on that I think it would be prudent right now that the RBA raised interest rates to 3.5%. catch us up to ECB, which announces soon. We're still 1% behind Canada, 1% behind US, and 0.75% behind New Zealand, and we have greater inflation than all of them. So if that doesn't happen this time, we'll see the Aussie weakening, and we're just going to see a continuation of inflation in Australia.
And I just like to pause on that for one little bit as well. I think people really need to understand what the Aussie weakening, how that plays into this situation, because that is the mechanism by which we import a lot of inflation, isn't it?
That's exactly right. So when your dollar weakens, your ability to buy goods overseas becomes more expensive, and therefore your inflation becomes higher. So if the RBA allows this to weaken more, we are just going to continue down one of those inflation spirals that all other countries in the world seem to be trying to get away from with the US. A lot of them are above US rates now. We are so far 1.4% behind the US now. And we have 2% higher inflation. So
yeah, those numbers all feed into each other. So something has to give to bring us back to some sort of reality amongst our peers, doesn't it?
Yeah, it's I mean, you've got a mortgage, I've got a mortgage. It seems like this is too much, but we're still under where everyone else is.
And
so,
we cop it one way or the other anyway. So we might,
absolutely,
if we're not copping it through the mortgage and keeping that Aussie dollar propped up, then we cop it through everything else when the Aussie dollar falls.
That's exactly what's going to happen. So I'm of the opinion that the RBA this week has, like, when the US raised by 0.25% at the beginning of the week, the US dollar dropped, Australian was looking great. Everything was okay. Lowe was going to do 0.25%. Non-farm payroll Friday threw a cat among the pigeons, and the RBA has one of those decisions that is actually, they will know what the right decision is. It's whether or not they have the gumption to do it.
To actually pull, yeah, that's hard. Well, Alex, thanks as always for your analysis and perspective on all that. We'll all be watching closely to see what the RBA actually does on Tuesday. And we'll be giving you a lot of credit if it is that 0.4. I personally don't think it will be, but and I don't think you think it will be either. But you've made a really solid case there of why it should be. So we'll see what happens, and probably more importantly, see what the wording is around that when it does happen.
Yeah, it's an interesting week, especially for the Aussie. There's no other data really this week, and that'll be interesting on gold too. But I am of the opinion that the US dollar does not have the rise it had last year, and gold has a small downtrend, and it will continue. But that's fine. That's just what markets are.
That's exciting to end on a high note. So thanks everyone else for watching as well. Remember, you can reach out to us with any questions or comments on the social platforms. We'll get to them and include them on the program whenever we can. I'll be back on Wednesday after the RBA's made their decision, and we'll see where we're sitting. So until then, everyone, have a great start of the week.